So yeah, last time we were talking about grabbing candles, right? Candles closing on floors, new highs, new lows, in terms of passing the baton, right? That's how we're looking for those new highs and new lows. We're looking for floors to be grabbed, which is grabbing the floor, or rock climbing. And then we're looking for passing the baton. So sellers closing price underneath. And that's something that we actually talked about today in real life because we had some ETF closures underneath where sellers control the price. And that's something that we look at for potential short trades. So now we will circle back just because we've missed. I want to move forward, but we'll circle back to that homework that you guys did do. And let me pull up your guys' chat really quick. There we go. But we'll come back to that homework and or I'll drop a video on that. Audio issues, you guys. Oh Lord have mercy. I wish there was something I could do. Yeah, just try to exit and come back in. Appreciate you guys helping each other. All right. So the question now, right? Because what floors are we talking about, or what, tops of what? And of course, this is where we're going to start digging into some of the more complicated stuff, complicated, if you will. But we're going to start digging into the Potter box theory. And so the question is, what the fuck is a Potter box? The definition of a Potter box is quite literally an area of consolidation defined by three main parts: buyers, sellers, and cost basis, right? How it's used is what makes it so dynamic. Where are they located? Potter boxes or structure. This is a fractalized strategy. It exists as long as the market is moving, it exists within it. So if you're a scalper, if you're a day trader, if you're a swing trader, if you're a futures trader, if you're a crypto trader, if the market moves, if they track price on it, it's going to likely have a Potter box, because if it consolidates or goes sideways at all, which is every stock on this everything that's tradable on this planet, the Potter box exists. And, again, this is why I tell people, doesn't matter what you do, doesn't matter how you want to approach the market. If you're selling options, right, after a large whip up and a large whip down, I can't hear anything. I have it at source, frame rate. Try disabling hardware acceleration on audio settings. Echo cancellation. Crisp is on there. Yeah, nothing from. It should be. Apologies. Yeah, if you guys are on the phone, well, it's not me. Okay. Well, this is being recorded. I'm really, really sorry if you're watching this back and you can't hear me. Sorry. But got to keep moving. So the point here being, me pointing this out, like, where are they located? This is exactly why I just made 130% on ELF equity, right? Large purchase down in the 55s. This is the same reason. Weekly, higher time frame setups typically take longer and are typically attract more equity purchases or leaps, stuff like that. Damn. Yeah, we got some people who can and some people who can't. So, anyway, what is the Potter box made of, right? So it's defined again by three main points. Sellers at the top, they push price down. Cost basis, or this is where the majority of the volume is within an area of consolidation. right? And at the bottom, where buyers hold and control the price. That is literally the makeup of what creates a Potter box. And this is an example of points of contact, right? And this is, again, where you can observe how price interacts, right? Because this is stuff that I don't talk about a lot. But within a box, right, the way that we distribute volume is really interesting, right? You close below cost basis within a range, you go to the floor. You close above cost basis within a range, you go to the ceiling. You close below cost basis or break cost basis, you're going to the floor, right? So this is actually some people, right? Yes, the top red candles, right? And this is today, somebody asked me, how do I find the top of the box or the bottom? I'm looking for typically the red candle on the top and the green candle on the bottom. Hold on. So with that being said, right, one could actually use these points of contact or that rule, because I've had, again, everybody is different, and this was proof enough to me. I've had people join the Discord and they love trading in range because it gives you, okay, above cost basis, you go to the ceiling, and I take profit there. And then if it goes to the floor or breaks cost basis within the box, but this is how volume is distributed. And again, cost basis was a tool that was discovered, right? I knew there was boxes, but when I started using volume profile and started noticing that the majority of the volume was at the 50% mark within these boxes, that's when it dawned on me that that's what we are displacing. That is what we are moving. That is what helps us move. That is where the volume is stored for that future move. So buyers, right? And this is how we define that box, right? They're found at the bottom of the box, defined by candle closes, right? So we can see that tap and the candle close and the tap and the wick, right? And this is something that if you see in this example, right? Do I have the availability? Hold on. Oop, no, go back. 1 second. Let me see if I have. Yeah, I should. Yes. There we go. So you'll notice, right, that there's, okay. One more time. There we go. You'll notice that there's 2 red wicks or 2 green wicks coming off of here. Now, on the higher time frame, right, it's not where the bottom would be, considering all of the points that are held in this particular range, right? Every single one of these candles does its job. Now, on a lower time frame, you might have, and this is why we do top-down analysis, you might have the box extend down lower, right? Now, the lower time frame is the hardest to trade, and that makes a whole lot of sense because sometimes you'll be halfway through what is a wider box on the 15-minute, and as you near that candle close towards the median of the higher time frame box, that still triggers it, right? At least on the higher time frame. Higher time frame is the most powerful. So what it says, right, ultimately goes, even if there's some small disagreement on the lower time frame. But regardless, this is 2 points, whereas this is 1, 2, 3, 4, 5, 6, 7, 8 points, right? So buyers buy anytime price comes into their control, unless they're out of juice, right? And so at some point, when you have this many points of contact, it lets you know that if buyers can't hold, there's a reason why they're holding. There's a reason why the floor is being held up. Top-down analysis. What is top-down analysis? Top-down analysis, good question. I appreciate you actually asking that question instead of letting it fester. Top-down analysis is just simply starting on the highest time frame, typically the weekly, and you do analysis on each time frame, the weekly down to the 24. and you come to conclusions on each time frame. Look, once you have the higher time frames charted and the play identified, the lower time frame serves as a way to kind of polish how that exactly is going to work. So, all right. But price closing under shows a loss of control. So buyers buying, this is why when price retraces back up and closes on that floor, the computers do their thing. Let's see here. All right. So this is a 24-hour box, right? Now, it's been a while since I've done this slide, and obviously this should be the 24-hour chart. But the floor is the floor, and that's something that I am able, because what you'll notice here is there is really not a whole lot of context, right? As far as there's not a lot of points of contact on the bottom of this box. So I typically will go with the first green candle on the bottom, just like I'll go with the first red candle on the top. And I don't know why I now looking at this going into the past, but that clearly needed to be raised up. Just a little bit, but right up to this top of this red candle. That being said, it doesn't really change much because the fact of the matter is that price bounces, right? You'll see first candle bottom close off the bounce is where the floor will be set, right? Notice is now how this candle wicks cost basis and closes under support after support is broken. This is sellers. This is one of my favorite parts. This is where you get to understand, right? Because it's like a spring. If you can't break the spring or push it down, it will recoil back, right? So while you may have had sellers try after a big push down and a break of structure, try to retrace back down and use that volume, they didn't have enough. So price closes under their floor, but doesn't lose the previous day's low. So the following day, you gap up onto that floor. The continued pressure, right? These candles reclaim support, regardless of where their wicks are, right? The wicks do go down, but the candles show that buyers have reclaimed that floor. And of course, cost basis above this creates that sellers are trying to push, right? Hold on. So sellers push down, creates tension. Pops right back up in their face, sellers push down, they can't close it. The next day, you can see, it was interesting, there was actually high volume on these 2 days, and those 2 days are where you see two tiny candles. This is both back and forth from sellers. It doesn't always have to be wide. Finally, that pressure is they're unable to do their job, and price explodes. Because when sellers don't do their job, everybody in here should know what how shorting works, where you're borrowing shares at a higher price and looking, so you don't own them, you're borrowing them, and then you're looking to buy them back or buy the shares back at a lower price and collect the difference. It's just trading in reverse. But when you go red, you have to buy, right, to get out of that position. And so that's where you would typically see a large move up, and that's what runs the motherfucking market. So, how many tries do sellers get to try? I wouldn't say there's a definitive amount of time, but there is waves. Typically, if you don't break your floor after the third time, the probability of you actually breaking it decreases quite a bit. Now, if sellers step up one last time for a fourth rejection, I mean, that's honestly where I'll probably look to take a position. Because at that point, it's almost inevitable. So Potter, in the example you're giving, if the candle close would have closed underneath, that means buyers would have lost control. There is structure underneath you, Junior. right? I don't have it on this example, but there's structure coming over here from your left. So remember, it matters what you lose. So sellers haven't done their job either. So if I have a floor underneath me and I haven't lost it or closed underneath it, then buyers aren't losing control, right? They still are doing their job, but we have not seen a passing of that baton. I should have included it in there. This is why I'm redoing it. So, we'll go look for those examples. Again, well, this is what we were just doing. This is what I'm showing you guys. Again, when we're passing the baton, you're looking to see if price, and especially on the higher time frames, can settle. And that's something that you guys can go and look at what happened or what's happening right now with the Qs and the ETFs, because it's in reverse, right? This is a little bit of a better example, right? Now, in this area of consolidation, right? Buyers marked out here. Obviously, sellers right across there. And of course, price flushes through the box that I have over here to my left. And it did end up going and hitting what it was ever, or whatever was underneath it, right? It's been too long for me to remember what it was. And I'm pretty sure this is still Microsoft, so this is probably just a description of what happened on that same chart. But regardless, this is a good example of price pulling itself back up above where that was a punch down intraday. Yeah, intraday, that was a punch down for sure. Now, candle bounces, right? Holds it. So the punchback or the distribution of volume occurred. You hit something and you've bounced and you've pulled yourself back up. That second gap allows price to move up. You have empty space, right? And that right there, and this is where I tell people, if you're using higher time frame trading setups, this is okay. So this is precisely my point. When somebody asked me this as well, and I think I confused you guys, a few of you, and again, we don't trade in structure, but when we're looking at potential punchbacks, right, that have empty space above it, it's of interest to us. So looking at this example, right, this is where the market opens up and you're here, you see there's empty space up in here, a floor right there. So your job would be to go down to the lower time frame, find this floor and what would need to be recovered on a lower time frame that could provide you an entry to take that. Because I don't mind taking, that's what I mean by top. What? You lost the stream. Oh my God, here we go again, dude. All right, it's back up. I'm really sorry, guys. I don't know why. Maybe this is BlackRock engineering the weather to try to stop me. But, well, yeah, maybe this Friday the 13th. I've always had great Friday the 13th, because I remember, like, I'll literally think, I'll be like, wow, today's been great. What the fuck? Yeah, I made 3,800 on a second prop firm account today. It's all right, I can see the screen but don't hear him. Oh my God, dude. Discord is fucking. Yeah, I bought another one. I was bored. There was lower time frame stuff going on, so I decided to. No, I didn't blow it. I'm in profit. I just need to make $4,500 on Sunday. Or yeah, Sunday. Yeah, you guys are gonna have to use but this is all being recorded, so. All right. So anyway, this is actually thinking about it from the other perspective, right? Buyers are also a defender of price. Candles close in boxes can signal continuation in that direction. So naturally, buyers, even after a lower time frame punch down, will still want to secure price on top of seller control or against seller control. No, hell no. So while we did punch down, buyers, and this is why I tell you guys to focus when we bounce, it's where do buyers take you? That is ultimately what's going to confirm that you are going to continue moving up. This is probably one of the most important one of the more important things that you can pull out of this is where a candle closes, and especially on a bounce, right? Because how many times have you seen a big red candle and then it bounces and people still are trying to go short, but it pulls itself back up and it completely reverses? And you know that, and we know that, because if you recover or a candle closes back on the floor, the next candle is likely to turn green. So something to think about. Now, that's also why I will continue to hold a position, because if you haven't lost anything, especially and this is also true up, because we had a lot of people getting out of Starbucks, and I get it, 400, 500, 300%, that's great. But we had a lot of people getting out of Starbucks because you just don't know. And that's not a reason to do something. In fact, that's a reason not to do something. You shouldn't have done it in the first place. But when a candle closes in the empty space, right? What else can you do? And it's like, we can't have control over everything, but what's in front of you? And how does it, based on your observations of price, how does price move through that? That's okay. Don't get hung up on it, Junior. It's over with, dude. I don't mean to bring it up, guys, because it's old fucking news. You shouldn't be upset with yourself anymore. You should already be planning the next, next trade. What's the next one? But it is a good lesson. Yeah, it's a good lesson for everybody. And it's only through those, you guys see, there's a lot of you who are doing it. It happens to me. And what do I tell you guys? How do I hold my contracts all the way to my target? What's the number one thing? There's two answers. There you go. There you go. Yep. You can say three, but yeah. So having your targets marked out, right? A to B, and trim. But how do you trim if you only have $500 account? Well, you're targeting things because that are literally $5 to $15. Yes. So when this, let me make this clear, and I'll talk about this again, I'm sure. When I trim, right? Let's say I have 50 contracts. Percentages typically don't matter, because when I'm looking at a chart, I'm not thinking about that. I guess maybe in the back of my mind, right? I'm acknowledging that that this is the exact same type of setup that gives me those type of percentages, right? Oh, that's it, right? The contracts are cheap. That's it. I don't need to do all that math all the time, and I can tell that if a target's only a dollar away, that's not what I'm looking for, but typically when we hit 100%, right? That is, when we hit that is, I was just going to say, that's the only percentage mark that you can acknowledge as a place to reduce your risk, right? 150%. That's where you could potentially take off the original investment, but after that, right? If you have 50 contracts, or 50 contracts left, or if you have 40 contracts left after that, at that point, if I have 3 targets, I'm probably going to end up trimming at each. I'm trimming at each target probably about 10, 10 to 8 contracts at a time. And then if it's something that's happening intraday, I like selling by threes, and I have them on ready to go. Mark it out, or ask as soon as I'll hit the ask, but as soon as it wicks down, that's where I, or moves towards that target, I'm already starting to sell. But as soon as that is done, as soon as my target gets hit and I've trimmed off 15, 20 contracts, what's the next thing that we're doing? As soon as a target is hit, and it's a target because it could be a resistance, what are we doing? Full port, that's great. Looking below, beautiful, Brian. What is above? What is below? So your immediate reaction is what needs to hold? What did you recover? How did you get there? If you can do that, you know where it's going to bounce. I watched that happen on the 1 minute today, and it was so easy to take bounce trades. I actually bounced IWM. I don't ever bounce shit, but like I bounced IWM for like $1,400, and then fucking it's funny. I entered off of the first green candle floor, and then it popped up or built a box, popped up, filled the empty space, made that money, let it go down, then ordered again off of the floor that was directly underneath it, and both bounced and responded. And the way that they fell, fast. So if you head towards a large level or a serious level, a 24-hour level, you're going to bounce. Even if it's temporarily, you're going to bounce. But so let's see here. When the price moves to open space and starts to build a new box, when would you consider the trade dead? So so if price moves to open space and starts to build a new box, okay, so it's slow in volume. It didn't have enough volume to actually start moving out of there. So yeah, if that's, I mean, that happened to me on Target. Slimy Cyber Slug, yes. There's a whole class specifically on that. Nice job. My cat just fell out of the fucking windowsill. Very smooth, my guy. All right. So again, where do buyers pull price up is going to determine where it goes. And then how we got there, right? This is where you could have seen this coming a mile away, right? Empty space. And even if you didn't want to get in here, getting in there still would have provided, obviously, a pretty good opportunity. Now, this is down on the 1 hour, right? The last one was the 4. That was the daily. And this is the 1 hour, right? And this is providing pretty cleanly price action for the most part. Feels weird not having my box in there, but whatever. Or my cost basis. Where's my presenter window? I think I like the blue one better. All right. So once a floor is built, it is seller's job to keep price from closing there, right? So what I'm saying here is that if sellers push price down, it's their job to defend the floor, right? So you can tell, and this is a really good example, right? Price moves down, it goes and wicks underneath, it bounces and pulls itself back up after not losing anything, and it's that candle right there, and every candle after it, that one, this one, and that one. What is it showing me? That price, that's the fist, that's the hand that grabs the side of the cliff. And you see that, like that right there is an immediate go time. You bounce that hard, and again, what are buyers looking to accomplish? What do they need to do in order to continue moving up? Remember our base camp example? You went back to camp and it bounced, and now you're back on that floor. You have the juice, right? You have the material, the supplies, the oxygen to go and make it all the way back up to the top. And by pulling yourself up on that ledge, you got a firm grip. This displaces sellers. Remember that. Sellers are trying. So what are they trying to do? They're trying to do that, but what happens when they do that? Immediately right in their faces. We're bouncing, right? And this, it's good to know the dynamic of what is happening, especially when you're coming to conclusions at the end of the day. Because this is where, even today, I kind of had to walk through what had been done on the cues. You open up, you go and touch something, right? You go touch the previous day's high, and then you just fucking fall, right? You can't hold. Nobody's interested. So you're going to have to find that interest elsewhere. And that's in reverse, obviously. But in this example, right, you held the floor, beautiful points of contact, right? Tap, tap, green candle right there. That candle right there marks that first candle open on top of the floor. You consolidate for a quick little minute, and you're up and at 'em, right? Once the floor is recovered, cost basis at the 50% mark is your next resistance. Once that is broken, new high. I just felt overwhelmed today. What did you trade today, Elon? Or did you just felt overwhelmed, period? Too much? That's okay. How long have you been in here with me? If everything made sense, that would be wild. I don't know if I'd be impressed or scared. But you're still new to this, right? You're very new to this. Be patient with yourself. Yep, totally brand spanking new. So, we should clip that message and send it to you in 2 months. All right. Remember, in this example, you can see the floor is held 5 times on the box the first time. This is an example of strength, so reclaiming a strong floor. So I get asked this question a lot, but this is important, right? If you have a loosey-goosey box where it's just this, nothing, none of this right here, but just this, not great. Seems like attention to intraday detail is very important. It is if you're playing intraday or you're looking for an intraday 24-hour setup to fire. But at the end of the day, typically you don't need to go down it too far, like down to the hourly or any farther than the hourly to start to describe what happened that day. Different days, different charts require different things. But yeah, especially, if you're day trading, for sure. So reclaiming a strong floor with higher time frame analysis in mind is a good opportunity to get in before the punch back. If the box is clear, the higher the time frame, the stronger the level. All right. So before we move on, does anybody have any questions? So on that hourly chart, when it grabbed the floor, that 1 hour candle needs to be closed for the confirmation. That is true. Yes. The candle needs to be closed. And this is the thing. It literally just lower time frame, lower reward. Higher time frame, which means more patience, which most people don't have. Most people don't see that all the way to fruition. They don't see that total move coming. So candle closes are important, extremely. So give it time. I've been there a few months and I was able to bring $50 to $1,200 in less than 2 weeks. Don't doubt the system. I saw that. Did you pull that out or what'd you do with it? Start with 50 again? Dude, if I was you, I'd start with fucking do it again. Might not be a bad idea. Do it twice. Then maybe move up to 200 or something crazy like that, you know? So it's your account, but yeah, just that'd be badass. But that's badass that you even did that. $50 or 1,200, that's monies. I'm assuming you probably had to wait for a really good ass setup. All right. Spy. Hell yeah. All right. What is it made of? We're talking about sellers now, right? Sellers have an important job to do. Don't let price close above control. This is also true on the floor. Keep buyers from grabbing the floor. Buyers set the floor and sellers set the ceiling. Yes, they do. Sellers set the ceiling. They control price at the top and they defend price at the bottom if it's trying to reclaim a box, right? So sellers, it's all a keep away, right? Because if you break outside of the top of this box, when you come back down, buyers are there to keep price from settling. It's a keep away game. So when you have price settle underneath, that gives control. Identified by candle closes at the top, typically, right? Yes, if you have multiple wicks all coming off the same price and body candle closes, that is your top, right? That is period, points of contact, points of contact, points of contact, points of contact. If you touch it, especially 3 times, that's important. That's a floor. That's a ceiling. That's control. That's your floor. Sellers sell every time price falls close in or closes or falls in their control. Wicks are not considered unless the wicks wick off the exact price multiple times. Typically, lower time frame analysis can solve this, right? But points of contact, let the chart show you where resistance is in an area of consolidation. Now, candle, and I did this, I brought up this example because I wanted to show the control. This is actually a box that typically an area of consolidation like this, I'm kind of kicking myself for using this as an example, but this was, almost 3 years ago. But this floor or this is actually what typically will make up a new box, right? Now, it doesn't have enough rotation. It has enough rotations to give it the start, right? And so the third one would technically be that break. Right. This would be more, I'm making new slides for the new workshop, which again is just everything that I'm teaching you guys right now, but with new slides and all in chronological order. But, you're not able to ask me questions. Anyway, the point still remains because 2 taps off both sides, that's enough for me to label it as a range, pre-box, if you will. But the top here, right? Candle close, candle wick. At the top is control. So I leave, and what I'm trying to show you guys here is that the candle to your left closes here, and the red candle opens there. And so the wick is not my resistance. That's where control is. This is a way better example. So where's the top? Notice that the first wick is off, the candle closes, and the wicks are blown through, right? Those are the wicks. Where do you see any stopping? Maybe you wick off of a little bit, but no stop. So control, right? Wicks represent where volume is at, right? And sometimes that volume is not something that you can recover. So you'll pull back. But that typically, like if you wick off of something, there's probably something resistance-wise above that you would mark out anyway. But control is ultimately what needs to break for anything to move, and that's established by candle closes. And you can see it in this range, right? Same candle closes, establishing control. real quick. We're going to switch slides. We're going to go find some. I have to resize the screen. Sorry. Okay. All right. So this is gonna go. We're gonna go establish, right, the tops and bottoms of some areas of consolidation really quickly in real time. A. Marking points of contact. Big red candle. Candle here, right? That's especially in day trading. Yeah. At the top, the candle closes and the down candle start. Not wait, what? At the top, the candle closes and the down candle starts. Not that both close there. Oh, yeah. You could, yeah, same thing, right? But it even on that open candle, you don't move higher. That's where the candle closes and ultimately where you open and push off. All right. Right. Yeah. So that establishes, yes, my control. So IWM, perfect example, right? Perfect example of a strong top resistance or control point. And you can see that this particular resistance has been quite strong regardless of where you move it, right? Here, strong, here, same thing. That is serving as our current resistance and is also where we would have to reclaim. Now, I would say that this is a little different now because you did reclaim it, and what that told you is that you needed to go up and reclaim the floor above it, and you didn't. So now it's 211.24 that would need to be recovered for you to get back up and out anywhere. All right. Do it here. Same thing, right? Points of contact. Wick. Here, right? The wick doesn't establish it, and it wouldn't have been needed to be established, right? Until you have that top 133.50. Now you can tell that PLTR on this 24-hour candle is trying to hold itself above it. This absolutely verifies that is where it would fall. Now, I see two wicks coming off the exact same price target, so I'm going to give it the floor. And so we could say that for sure that PLTR would pull back more than likely into like the 128 level if it was to pull up, because buyers right now have a job to do, and that is to keep it out of sellers' grips. So when you look at it to TP at imbalance and look left for the first green candle, do you look for the wick or body as resistance? That's a great question. So I have to consider the wick. That's a great question. So he's asking, when you look at a TP2 at imbalance or the first green candle to your left, what are you looking for? The wick at the bottom is typically where I start that trimming process. Because if it's a strong enough wick, far enough away from control, it'll serve as a temporary rejection point. All right, Shirley. It's all being recorded. Should we use the 3-wick or candle or their combination of the top? Should we use the 3-wick or candle at the top? Basically the combination. The combination. So it could be the wick, the body. Like in this example, like you see wicks are leaving, right? But there's no uniformity there. Hold, rejection, hold, and then you can see that works there too. So it doesn't matter. Whatever establishes resistance is resist. Like if it's points of control, if it's all wicks, right? Pure wicks. You're just wicking off everything. But my personal favorite, right, or my personal, what I like to look for, especially on the floor, I would say, but I like candle closes. It just shows control. See? And look how price responds to said box. You haven't even gone and filled that gap down at 88.50 on PLTR because the box did its job. Buyers did their job. All right, let's see what else we can find. That's going to be doo-doo water. That was a beautiful punchback. Beautiful punchback. Now I'm going to go right here. And right here. Starbucks is nice. Let's try not to use that as too many more times as an example. So this is another example, but this time in reverse, right? But we're also just trying to establish where the tops and the bottoms of these boxes are, right? So we can see the wick, the body, and the open there. Simple. That is your top, right? Cost basis gets retested here. Doesn't it actually look? Have a look, guys. That is a perfect example of losing your grip. You can screenshot whatever you want. Yeah, that's fine. Whatever you need to. They got a loose grip. It's not grippy. So that loss. Now, this is also a beautiful way to start to this is why I want you guys to keep charting. This is why I want you guys to keep charting and be motivated, not just for the money. Guys, listen, this is one of those things that you almost have to trick your brain. You do the work, you learn the strategy, you learn how to operate with inside of that strategy, and the inevitability is that money will come, right? If you want money and then you try to you got to start with that right mentality, because taking the time to observe how price moves is so important. But once you start to see it, it becomes way more clear, right? How did Oracle rip up to that box? Now, what do I always say? If you're going to move through structure after ripping hard, what do you got to do? Keep your motherfucking foot on the gas pedal. This is not gas pedal mentality, right? You gap up, you try, and you fail. You get pulled back down to the floor. Buyers try and pull you back up after filling their gap, and you fail. Next day, you gap down, and where'd you gap down to? Under that floor. So you go up, you don't even fill your gap, and look how you fall, the same way you went up. Straight to the floor. Fast and hard. The same way you fall is the same way you rip. Now you could even look at this right here. While you could say it was disappointing, you're in balance in that empty space. That's where you bounced off of. And that happened pretty quickly too. But so hear me out, right? Now this is where people are like asking me about Oracle. Like, listen, you missed it. Like I'm not looking back anymore. Like I would rather wait, right, to see or find some sort of higher time frame structure, because you built a box here, you grind to the upside, you almost make it impossible to trade, and then you start breaking down. So, with Oracle, you'd have to, everything would be lower time frame setup. But that's a good example of a box. Oops, what the fuck is even that? When you see good setups, but the option chain doesn't look, or looks, doesn't, wait, what the fuck? Option chain doesn't have a spread. What do you do then? So like if the option chain does have a spread or doesn't have a spread. If it doesn't have a weird spread, then I'll take it. If it has a weird spread and it's expensive, I'm not taking it. Yeah, if it doesn't have a good, yeah, if it does not have a good spread, fuck that. No compromising. The market provides two. I don't know, dude. Maybe, but I just prefer to stay away from those things. That was my next question, Oracle. How would you have caught it? What were the signs in your example for teaching? So I did not take it, but I know a couple of other people did. And I think one of the main things that I mentioned at that point was that Oracle would have to go and punch through 188.82. And if it did, the sky's the limit. Was there a for sure, like, that is going to happen signal? I think if you look out on the weekly, that kind of was a little bit more apparent with the range being broken, the floors being recovered, and being close to where sellers had originally pushed this back down. But this isn't like the most, it was a great move, but it's also something that, didn't really scream. It screamed speculative setup for sure. But yeah, I don't think I can't remember why I didn't want to take it, but might have been the contracts too. I mean, the play was, and I guess this is the 24 hours. So when you opened up on cost basis, that was your sign. So you could have missed earnings, but it would have been the open on cost basis and the close outside of it that would have been continuation to the upside. Punchback on Oracle? Where? On my chart? Oh, Starbucks. No. That was the point in which Starbucks tried to go and recover a floor. You on the lower time frame? No, that was a gap. I think there might have been a lower time frame box right there, like a little baby one. But that still was the only trigger that you really had there. So, oh no, that was not a punchback. No, no. I typically don't trust straight line moves off of floors. Typically, you consolidate after that. Um, hold on. So since you say don't look behind empty space, but if structure matches existing structure, and that's the inside structure of a box, that's still good to make a box. The most recent price action is adjusted to the previous price action. So I don't see any need to go back unless there's empty space through it, like on Starbucks or something. Apologies, Garrett. Does it have to be perfect closure at the line, or is it okay if there's a small variation? Asking because if I zoom in on Oracle example, the 2 points are slightly below the line. Wait, what are you talking about? Perfect closure at the line? What do you mean? Perfect closure at the line? Are you talking about over here? If it's a general range, I mean, if it's like a fucking 2 cents off or something, that whatever. Yeah, points. I'm not sure if that's what you're asking about, but Okay. Okay. So as far as finding and setting up boxes, right? Points of contact are the most important, right? In terms of, but preferably we like to see candle closes. If they're the other outcome is that it's off the multiple points of contact with the wicks. But as far as the floor and the top are concerned, um, that is how we are identifying, right? Our tops and bottoms of a candle. You know, Oracle here too, same thing. But we are looking for candles that are opening up inside of each other and candle closures at the top and the bottom, or points of contact in order to establish our ranges. On Starbucks, what did you see when you trimmed heavy on what when it started to roll over? Wait, what? You mean downside? Starbucks was point A to point B for me. The only area that I trimmed, yeah, I trimmed up in the 9462s as we were on approach. I did trim at the 50% mark because it was well over 100%. And then yeah, I let my trade go. Is there a reason that you chose that as a box to start for Oracle? What do you mean? That box to my left? More points of contract does mean more control. Yes, it does mean it's a better box. Yeah, that's okay, RGB9. Okay, we'll do one more. Try for a hard one. On hold on a second. Yes, more points of contact, better Potter box. Yes. On Oracle in the 24-hour time frame, there were 3 tops. Would you continue to reestablish the top as it 3 tops on Oracle? You mean this? That's 2 for me, right? That's 1. That's 2. Technically 3. Yeah, I get. Is that what you're saying? Like this break was the 3rd on the left? You talking about the wick? Trying to track what you're saying. There are 3 rounding of price. Let me see. Uh, 3 rounding of price. I mean, I don't see that. I'm not including this at all. That's not going to be included with the rejection. It's just cost basis. But I see 1 here and 2 there. That's it. If that's what you're talking about. The floor gets hit a couple times, but That inconsequential. If anything, I think that just you literally build, you're just putting volume in to start the range to build cost basis. This big from top to bottom, right? The punchback that you actually had, right? Technically, that was a box. You punched through it, you made a new high, then you lost it, then you went to your floor, and you wicked down, and you pulled yourself back up, and then you went and hit your high again. And technically, this time you went and made a new high, but it still counts as that second rejection because control pulled you back up, pulled you back under. So my point here, and I guess again, that doesn't touch the same high, so it's not. That's one. That's two because you have the same points of control. Does that make sense? Sorry, I am congested right now. Yeah, I mean, so boxes typically form when targets are hit, right? So, and I said this on Starbucks. Starbucks might have the strength to get back down. Uh, and this is why people get fucking toasted. I'm serious. This is a huge reason why people get crushed when it comes to trading. They'll see this huge move, right? And they might hop into it and cap a little bit of it, you know. But at the end of the day, you come down here and you end up touching or moving into this structure, right? This is a large 24-hour, 4-hour structure. It is box to box. Empty space is filled up to the T. And factually, yeah, look, the end of empty space, basically, just a fucking tick off becomes your floor, right? You probably, hold on. Yeah, shit, I'm off. I'm looking at the 2 wicks. The end of empty space, right in there, for sure, becomes your new floor. Empty space, right? You bounce up, you feel the 50% mark. That creates the range that you continue to trade in, right? So you might have a chance. And here I think Starbucks did provide a decent lower time frame box once it started, popped up, hit its imbalance, and started the torture chamber, workout. Um, at that point, right? My point here is that this is just how the market. So let's simplify this. The market will consolidate, expand, hit the box in front of it, and build a new box. That is what is 9 times out of 10. That is what is going to continue to happen forever and always. And this is why, if you miss the move, get really good at just getting over it. Okay? I don't know if any of you guys were ugly in middle school. I was. And I lost a lot of girlfriends or just even opportunities to even date anybody. You know what I'm saying? I lost a lot. Look at me now. What were you talking about? Oh, shit. Still ugly. No, you're not. I like you, Alex. Oh, dude, you should see pictures of me when I was younger. My ears, my arms, and my legs and my feet grew faster than everything else. So I look like a fucking orangutan for like, 3 or 4 years of my young adult life. I was on the monkey bars one time, and someone fucking made fun of me. They're they're like, you look like you were made for this. Piece of shit. Wait on a Elon Musk. That is, goddamn it. You should get that. We'll get that tattooed together. Okay, but straight up, wait on a great setup. Step 2: know what a good setup is. Empty space, consolidation. Find it before it leaves. How do I confidently take a trade on a candle close outside of a range only to be faced with a punch back down into the box that was lost? Is that something that like happened recently? Hold on, let me read that. How do I confidently take a trade on a candle close outside of a range only to be faced with a punch back down, punched back or down to the box that was lost? It seems like the punch is kind of the enemy of the breakout, so I'm not really sure I understand what you're saying there. Rephrase that for me if you can. I got to start using the same word, structure and range, right? Oh, well, yeah. So like, isn't a punch back a move into the back into the box? So does that guarantee that it's going to continue moving down? No, a punch back, right? There's a punch down and a punch back. I call punch backs up, right? And that's where we're looking at it. This is not a punch back, folks. Not at all. In fact, in the most recent price action, it's just a box, right? And empty spaces above it. Now, if we were to move through this fucker, which we hit today or hit the other day, right? And punch through the 50% of that, that would be the next signal. So a punch down, right, would be yes. And this is why, listen, I took a position today, guys. I might get cooked. I put about $1,500 into this, so I might get cooked. But I figured it was futures that maybe do it. No, I figured that with a good hedge, if anything, I'll break even. But I took a position on this Sparkles, and flipping from the upside to the downside is a difficult thing to do. You know, it takes a second, even for me, still to this day. To this day, I still struggle with flipping. Like, okay, all right, mostly because I also just have like this criteria of shit that needs to happen. And sometimes it takes a long time to happen. But I took a position on IWM down because of what we're talking about now. Now, let me explain to you the risk. The risk of me doing what I'm doing is that we bounce on the median and go right the fuck back up. Because I'm taking that position early, right? And the target right now is going to be right here, and that's likely where we will bounce if there's going to be a bounce. So with that being said, right, if you want to avoid that, you're the top. Yeah, I saw that. I saw that. Yeah. The market reacted to it. But that top would be my stop loss. So getting as close to it as possible, Sparkles, is incredibly important, right? Having your entry be at the top of that box is ultimately the best situation you can create for yourself, right? So if you take something early, and I said this today, because listen, I'm going to be bummed out if this don't work. I'm going to be bummed out if we open up and we're back right up here. I'm going to get fucking cooked, right? And, you know, $1,500 loss, hopefully with a, you know, $400 hedge or $380 hedge should be enough. You know, how many times have we seen $380 go to, you know, $1,000, $1,500? So if anything, you know, hopefully I'll walk away relatively unscathed. But ultimately, I know that if we break back up above 210, and I did say this just a second ago, or just before the close, because we did do that on a lower time frame and then failed to grab the floor above us, we know for sure that we will be moving back up if we reclaim 211.11. For sure. And you cannot be mad at the market if you take positions like I just did. But I can afford it. I can afford it. That's the biggest difference. Is I've done this. I've been through I built my account up. I can do this. And $1,500 is I would say it's a little bit heavy to be called speculation. The candle closed underneath the thing. I was taking a shot because and maybe a little bit of it is because I did this before on the Qs and I hesitated. The last time we did the exact same thing. We closed underneath. That's when it all starts to fall. That's where all the volume is at. And that's when you know. That's when you know. And so I'm trying to look at that same thing now, but I also know that it doesn't matter what happened last time. What matters now, and this on the Qs here, folks, this is also a good example because look, your old box top is now your cost basis. So when you break cost basis, you're breaking under where sellers control again, and we come down. The main point here is that 2 candles top, we're closing underneath it. So the risk is right now that we bounce right off of cost basis. Does that make sense, everybody? Everybody following along here? Okay. Now I'm going to take a second to point this out while we're in here. Because if you're somebody who trades the ETFs, you need to know this. And I don't know if everybody knows this, and some of you already do know this, but while we're here and we're going to talk about it, just really briefly, because I was just saying this, most people lose because the move is made and they start to try to trade then. Because most of us are wait for the move. That's all you trade with, and you're going to want to hear this, right? If you're somebody who has good weeks and then bad months on ETFs, or you make a lot of money on SPY and then all of a sudden now you're losing it, if you trade every day, and to the person Teeler, if this is you, this is going to apply to what I'm about to say. I use the surfing example because it just works for me, but y'all, please listen to this because sometimes I just want to shake people because this was the hardest thing for me to learn. We are dancing with the market, right? And in order to be a good dancer, you got to know the moves. We go through the same fucking cycle every time, everywhere, right? We get a series of consolidation. That series of consolidation typically occurs when a 24-hour level is met, right? So that consolidation right now, you could have for the last couple of, basically since May, halfway through May, right? And this is something that might be a hard pill for you to swallow because, yeah, there is lower time frame setups. And yes, I've caught a few of them. But at the end of the day, and this means that if the ETFs are going through that consolidation phase, find a individual equity to gravitate towards. Go find a setup outside of those ETFs because you're likely going to, that's forcing a trade. We are a group of people who are looking for the consolidation that makes people lose, that causes the decline of contracts via theta to disintegrate. We are buyers of those broken down contracts, not the holders. And if you're inside of range, you are the holder of that loser. So if you are somebody who trades the ETFs, right? And I said this a couple of months ago because we were running out of empty space, right, in here. I said, once we get up above this level, we have this pocket. Guys, this was quite literally, I don't know if anybody remembers this conversation. I do. That pocket. Do you guys want to know where we rejected? Right there. That was the last little bit of empty space. And so now, right, if you want to make sure that you're in a good place, if you are aiming down, while I might speculate, this is the start of that break, because what's underneath it, which is this, that is ultimately what will open up the trade for a move into the downside, right? So you might have to wait, but at some point, if you can just recognize that the market is going to have, typically you, and again, we use this, this is a useful, really useful tool. Everybody on every stock, you know, that you chart, it's good to go and figure this out. There's typically an average date range that every stock will hold, or even ETF, right? In this case, you actually consolidate just a little bit longer, a couple of extra days. And I'm not on the 24-hour right now. So you have 7 days. 7 days right there. This is 7 days, and then you get a breakdown. It range is a little bit too long. So, and this is also why I decided to take a position, because we're getting to that point. And one thing that I saw last time on the dump is that when you go up to the area that provides the opportunity to go into new highs, and then you get these stupid candles, look what happened last time. Above the wall, 1, 2, 3, 4. Nobody wants to buy. I'm observing that very same thing. 1, 2, 3, 4. Nobody wants to buy. So with the consolidation that we have, right, it's time for me to start looking at a potential move again, because that wave is almost done, or that swell, if you will. But one thing that I can also say is that the ETFs in their current state do not provide, at least Qs don't. IWM, I think, has a little bit down there. And that's mostly actually on a lower time frame. SPY, oops, that's soy. SPY, nothing happens until you get basically the punch down or the move down. Whoops, overzealous there. Which is still quite a bit of ways. 590.50 on SPY. But anyway, the point there is that if you are trading, whatever it is that you are trading, go find that consolidation range average, and it will become an incredibly useful tool for you in the future. All right, so I think for the most part, we've kind of established finding the tops and the bottoms, right, of ranges. We'll continue to be doing this as will you. But we'll go ahead and turn back to the slides here. Take a second if you want to go get something to drink or go to the bathroom. Take a quick intermission, and then we will continue.